What separates a successful investor from someone who loses everything? Often, it's just a 30-second piece of advice on a cell phone from a clip on TikTok or YouTube Shorts. Today, we will analyze viral strategies that destroy real wealth. Brace yourself, the cost of misinformation is higher than you imagine. Early in my career, I watched a trader blow up his entire account in less than a minute. Reality is cruel. Extreme leverage without protection is a jump without a parachute. When you ignore risk, the market bills you with compound negative interest. The search for shortcuts leads to impulsive decisions in assets with no real value. The human brain loves the idea of winning big while spending almost nothing. But in practice, what seems like smart arbitrage is just hidden risk. I once met a young trader who financed a car during a market boom. 2 years later, he still owed more than double what the car could sell for. Imagine buying a car that is worth less than half of what you still owe. There are people in social media carrying vehicle debt that amounts to almost triple its market value. We're talking about a financial hole of nearly $100,000 in just one asset. Some advise refinancing the debt with the bank. More often than not, refinancing rates suffocate cash flow. Interest rates historically ranged between 1% and 5%, according to Federal Reserve data. With credit cards, the situation is worse. According to Federal Reserve data, interest charges reach almost a third of the amount owed. In the commodities market, a TikToker made a wrong bet on copper that led to a total loss of capital. Another influencer was trading derivatives without safety orders, which resulted in him being forced out of the market. The remaining balance after this mistake exceeded $8,000 in pure debt. There was a YouTuber teaching the strategy of paying only interest on real estate. This is a time bomb. Without amortizing what was borrowed, net worth becomes an illusion. Another pulled nearly $100,000 in cash from his home to roll over debts. The consolidated result? Personal and business debts totaling over $60,000. All this from following trends based on meme digital currencies. We saw this again and again during the meme coin mania of 2021 and 2022. Another one, and this made me laugh, I confess, was trying to juggle multiple remote jobs. The financial market is not a video game. Losses are permanent. Stay away from magic formulas that promise the world without mentioning risk. The foundation of wealth remains risk management and patience. True financial freedom does not come from a viral video. It comes from solid, well-founded long-term decisions. Beware of those who offer the easiest path. Usually, it is the fastest path to loss. Protect your capital and focus on what truly matters. Sustainable success doesn't need dance moves. It needs strategy. Imagine an account where all the accumulated profit belongs exclusively to you. Many American investors discover this only after years of paying unnecessary taxes. The Roth IRA. No fine print and no slice for the government at the time of withdrawal. Today we are going to talk about the Roth IRA, a tool for financial freedom. Unlike other plans, it does not depend on your ties to any company. You have total control and custody at major global institutions. We are talking about names like Fidelity, Vanguard, or Schwab. The secret lies in how the tax authorities handle your money. Unlike the traditional model, you don't deduct the amount now. But in return, the capital growth is completely tax-free, according to IRS Roth IRA rules. In the future, every cent withdrawn will be 100% yours. It's a technical advantage that surpasses almost all other investment vehicles. You can invest in index funds, bonds, and even in the international market. This allows for diversification that protects your wealth over the long term. There is the possibility of maintaining this account alongside your career plan. That is, you can accumulate wealth on two simultaneous fronts. But attention, the government imposes annual limits on these contributions, set by the IRS. The cap for this modality is lower than in traditional corporate plans. Furthermore, not everyone can contribute directly to this account. There are income brackets that restrict who can get into this game, defined by IRS guidelines. Another rare benefit is the absence of required minimum distributions. You decide when and if you want to withdraw the money during retirement. In common plans, tax is levied on the total amount upon withdrawal. In a Roth IRA, this concern simply ceases to exist. It's the difference between sharing your profit or keeping the whole pie. The focus here is on the benefit you will reap a few decades from now. About 10 to 20 years of compound interest changes the level of any family, as retirement studies show. The strategy is simple. Pay the tax today on the smaller amount and protect the greater fortune that will be generated over time. Investing with tax efficiency is what separates amateurs from big players. It's not just about how much you earn, but about how much you keep. The Roth IRA is, essentially, a shield against inflation and taxation. Starting early is the factor that weighs most on the final result of this account. Plan your future with tools that play in your favor, not against you. Why is the simplest strategy in the world the hardest to execute? Buying low and selling high seems obvious, but your mind plays against you. Today we will understand why fear and greed defeat financial logic. The cost of ignoring market psychology is the ruin of your capital. Half of stock market success depends on numbers, the other half is pure behavior, as Benjamin Graham warned. Benjamin Graham already warned about this decades ago. The investor's worst enemy is usually himself. If you don't master your emotions, financial fundamentals won't matter. The market moves in an emotional cycle divided into 5 major stages. It all starts with speculation, where the focus is solely on projections and future profits. Soon comes optimism, when prices rise and the fear of missing out attracts the crowd. It is at this moment that capital flows into assets due to pure social pressure. But when value drifts from reality and bad news arrives, the bubble bursts. In this chaos, large banks and global investors get ahead. Giant institutions sell their positions before the average investor perceives the risk, according to Bloomberg market analyses. After the crash, we enter the valley phase, the lowest and most painful point of the cycle. Here, only those who analyze real cash flow and the industrial base can see the opportunity. Recovery only appears with new partnerships or renewed management in the sector. To not get run over, you need an exit plan before you even enter. A well-defined safety limit protects your money from uncontrolled losses. The golden rule is to never risk more than 1% of your operating capital. If the price falls and breaks important support levels, the order is to sell to survive. Remember, assets that are too expensive have little room to grow and a lot to fall. The stronger the trend, the more the volume and market agitation increase. A serious analysis combines the health of companies with the global economic situation. The common mistake is buying at the top out of optimism and selling at the bottom out of panic. Psychology explains why the retail investor usually arrives late to the party. Beating the market requires the cold blood to go against the emotional current. When everyone is euphoric, it's time for extreme caution. When fear dominates the streets, the best value opportunities arise. Discipline and risk management are the only vaccines against behavioral bias. Don't try to guess the future. Learn to react to what the chart is saying. Your investment portfolio thanks you when you leave your ego out of the operation. The secret is not just knowing what to buy, but knowing when to leave the scene. Subscribe if you want more analysis like this, and comment below, what financial topic should we break down next?